Little that he knew, this turned out to be a blessing in disguise. Warren Buffett is considered by many the best investor of all times. The Oracle of Omaha was 11 when he bought his first stock, and by age 16, he had gathered more than $53,000 from various business ventures and investments. After graduating from the University of Nebraska, he applied to Harvard Business School, but was rejected. After much disappointment, he discovered that his idols, Benjamin Graham and David Dodd, were professors at Columbia Business School. So he went there instead. Little that he knew, this turned out to be a blessing in disguise. He learned from the best, and by age 89, his net worth was $81 billion. Buffett is 91 today, and he won't be around forever, but we can learn a lot from him and his partner, Charlie Munger, who's 98. They both have the same principles you need to abide by if you want to become a great investor. Before I begin, I want to give a shout out to Joshua Rodriguez from Money Crashers for writing this article. The link is going to be in the description. So drop a like, subscribe to the channel, follow me on Patreon. Let's get right into it. Principle number 1, know what you're invested in. Warren Buffett never makes a blind investment based on hype. For the longest, he refrained from investing into tech companies because he just didn't really fully understand their business model. He said once, I don't have to swing at every pitch. I just have to wait for the right company to come around so I can take a swing at it. Principle number 2, an investment must fit into a specific criteria. When determining whether to invest into a company, Warren Buffett holds companies to the following criteria. Number 1, the company must be sensibly priced. As a value investor, he looks at the price to earnings ratio, price to book value, and the price to sales ratio to make sure that he's getting a good deal. Number 2, management must be quality. He believes that it is important to understand who's running the company to make sure that the management team doesn't run the company into the ground. Number 3, the company must be aggressive with its reinvestments. Buffett isn't primarily concerned with earning dividends or income from his holdings. He sees aggressive reinvestments of net capital as a far more lucrative endeavor. And number 4, the company must have strong earnings power and it must be generating compelling profits. Principle number 3, look for economic moat. A company's economic moat includes a strong brand, patents, and trademarks that keep competitors at bay. Think of a moat around a castle during medieval times. There were vast bodies of water that surrounded the castle, keeping the enemies from getting in. Principle number 4, cash is an investment. Warren is happy to hold on to cash if there are no good deals for investing at this time. Liquid cash gives him the opportunity to jump into deals when he sees one. Principle number 5, don't sell it and forget it. As a value investor, he's one of the most active investors in Wall Street today. He looks for any stock that has fallen out of his criteria and is not afraid to sell it or jump out of it. During the pandemic, he actually sold most of his stakes in airlines and food industries. He knew that with the lockdowns, the business profits will suffer. Principle number 6, sell when value dissipates. You should have at least a rough idea of the fair value or market value of your investment based on your research prior to your decision to buy. At this point, don't be afraid to take in some profits and use this cash to invest into the next opportunity. And now you know how to invest correctly, like the best investor of all times, Mr. Warren Buffett. I hope you enjoyed this video. If you did, make sure you drop a like, subscribe to the channel, but more important than that, make sure you take care of yourselves. And I'll see you soon.
I bring up the pain, Rick service the mind. I make the market rain like acid rain. An investing channel you ever known, ya. I take your girl, your house, your money, and leave you broke, son.